The collapse that some call the mother of all disasters. Do you remember the name of the company that started it all? Lehman Brothers? Yeah, I didn't think so. Well, their bankruptcy in 2008 triggered a sequence of events that led to the largest financial crisis since the Great Depression. So much so that the U.S. government had to step in and bail out companies and banks that were considered too big to fail. A bailout that cost taxpayers billions of dollars and left many wondering who's next. But in reality, there's a good chance you already got your answer. And it's yes, because despite the fact that the consequences of the crisis of 2008 led to the worst recession in the United States since World War II, everything returned to normal very quickly. Markets recovered, people kept buying houses, and the economy continued growing. However, recently, the tone has started to change. According to experts, we've been on a path of excessive risk-taking for many years. And finally, we may be reaching the end of the road. As Albert Edwards, global strategist at Dutch bank and insurance group SNS Real, put it in a recent report, once the world realizes the party is over, everyone will want to get out at the same time. But before I share with you his predictions about what's coming and what you can do about it, let me ask you, how did we get here? What are the main reasons we might be looking at the next financial disaster? Let's take a look at 3 of them. First, the excessive amount of debt I talked about earlier. Debt. Governments, households, and businesses borrowed heavily to fund spending. For example, the U.S. national debt reached a new record of $33.7 trillion in late July. Households increased their debt balances on mortgages, auto loans, and credit cards, while businesses piled on corporate debt. Second, the Federal Reserve's monetary policy, which kept interest rates at near zero for a prolonged period, stimulating borrowing and lending, but also inflating asset prices. Third, loose fiscal policies with governments running deficits and increasing spending without necessarily increasing revenue. This combination created a perfect storm that could lead to a financial disaster. But the question is, how close are we to that disaster? Well, according to Michael Burry, the famous investor who predicted the 2008 housing market crash, we could be closer than we think. In a tweet last week, he shared an article from the Wall Street Journal titled, "Why Deutsche Bank Says There's Only a 20 Chance the Economy Soft Lands." He added the comment, in Q3, suggesting that quarter as the potential time frame for the crash. The soft landing refers to the hope that the Fed could raise interest rates enough to slow inflation without causing a recession. But, as the title of the article suggests, the chances of that happening are slim. The article highlights that the job market remains robust, wage growth is high, and consumer spending is still strong, which could keep inflation elevated and force the Fed to keep rates higher for longer. Plus, global headwinds such as the war in Ukraine, tensions with China, and the slowdown in China's economy could worsen and create more uncertainty and volatility in the markets. So, what does this mean for you? What are the implications for investors and homeowners? How can you prepare for the potential crash? Well, here are 5 things to keep in mind. First, expect more volatility and uncertainty. The market downturn has already started with the S&P 500 down about 20% this year, but it could get worse before it gets better. So be prepared for more ups and downs, surprises, and shocks. Don't panic and sell everything, but stay informed and flexible. Second, review your investments and reduce exposure to risky assets. Assess your portfolio and cut back on speculative or unprofitable ventures. Diversify into safer options like bonds, commodities, or cash. Don't chase returns blindly, but seek stability and resilience. Third, monitor your debts and avoid taking on more debt. Check your loan terms and interest rates. Consolidate or refinance if possible. but avoid variable rate debt or adjustable rate mortgages that could increase significantly. Manage your liabilities wisely to prevent them from becoming unmanageable. Fourth, boost your emergency fund and cash reserves. Aim for at least 3 to 6 months of living expenses in a readily accessible account. This will help you weather any unexpected job loss, medical bills, or other emergencies without dipping into your investments or taking on more debt. Fifth, continuously educate yourself and adapt to the changing market conditions. Learn about personal finance, investing, and economic trends. Follow reputable sources and experts, but also question everything and form your own opinion. Be open to new ideas and strategies that could help you navigate the crisis more effectively. For example, one of the most promising sectors right now is renewable energy. As governments and businesses seek to reduce their carbon footprint and transition to sustainable practices, the demand for solar, wind, hydropower, and other clean energy solutions is growing rapidly. One company leading this sector is First Solar, a major manufacturer of solar modules and systems for utility scale and distributed generation applications. First Solar has been expanding its production capacity to meet the rising demand for solar energy and has recently announced plans to invest over $1 billion in new manufacturing facilities in the United States and Ohio. These facilities are expected to create hundreds of new jobs in the region and boost the domestic production of solar modules. First Solar is also developing innovative technologies, such as its advanced thin film module, which offers high efficiency and durability with a unique cadmium telluride thin film design. Overall, First Solar is well-positioned to benefit from the growing adoption of solar energy and to play a key role in the energy transition. So, consider adding FSLR to your watch list. You see, preparing for a potential crash isn't just about protecting what you have, it's also about seizing opportunities to grow your wealth. That's what the best investors do. They anticipate market downturns and position themselves to benefit from the recovery. So what should you do right now? You should invest in yourself. Dedicate time and resources to enhance your skills, knowledge, and adaptability. The crisis won't last forever, and when it ends, there will be a lot of demand for talented and versatile individuals who can contribute to the recovery and growth. So don't neglect your personal development. Embrace lifelong learning and make it a priority. Attend workshops, courses, read books, follow industry trends, and stay updated. Your investment will pay off. And if you want to know more about the crisis and how to protect your wealth, watch this video where I explore the insights from Yuval Noah Harari, one of the world's leading experts on global trends and challenges. You'll discover the hidden forces shaping our future and learn how to thrive in the face of uncertainty. Do not miss this opportunity to secure your financial well-being and join the ranks of the most successful investors of our time. Subscribe now and secure your spot. Now, let's get back to the video. In conclusion, we are living through a unique and challenging time in history. While we may not be able to predict the future with certainty, we can learn from the past and prepare for what lies ahead. By understanding the causes and consequences of previous crashes, we can avoid repeating the mistakes that led to those disasters and position ourselves to benefit from the opportunities that arise from market downturns. Remember, knowledge is power, and staying informed is essential. By educating ourselves and adapting to the changing market conditions, we can navigate the challenges ahead and secure our financial future. So don't panic, don't sell everything, but do stay alert. Thank you for watching. If you liked the video, please hit the like button and subscribe to receive notifications of my next videos. Wishing you success on your journey towards financial freedom. Until next time.